pleasure to talk to you today on navigating the impact of the Inflation Reduction Act of 22. So this has been up and running since the beginning of 2023. And I think in a time of some uncertainty around what's happening in Congress with respect to some new bills and other things like that, the Inflation Reduction Act is definitely up and running, and we're seeing a lot of activity around it. And so I'm happy everybody has some interest today. And we're going to talk about a variety of things today, but I want to introduce, and they'll do a little more introduction for themselves, but some of my team. So I'm Marty Kerman. I'm the partner in charge of our tax credits and incentives advisory group. We're a group of approximately 50 people focusing on all things tax credits and incentives, both federal and state. But I'm also joined today by Tim Doran, who is in our energy practice, specifically on the side of investment tax credits and production tax credits. And he's going to talk a bit today, along with David Moamani, who's a manager in our group, around some of the various new enhancements that we've seen and where companies are working with us now in ways they hadn't been around ITCs and PTCs, transferability, direct pay, application-based credits. And then beyond that as well, and who will begin this for us is Bill Harbison, who is focused really on what we'll call the real estate and construction aspect of the Inflation Reduction Act. I think all things 179D and currently and in the past 45L, they go through Bill when it comes to working with us here. We've seen quite a bit of activity there too, a lot of opportunities. So we're going to talk about that now, and let me continue on the slides. So as mentioned, we're going to talk just a little bit about overall Inflation Reduction Act. Again, begin with the real estate and construction aspects with Bill Harbison. And then for the rest of the time, David and Tim are going to lead us through a variety of, not every aspect of the Inflation Reduction Act, but some of the salient points, areas where we see some of the most activity and opportunity. You can feel free to put questions in the chat as we talk to you today, but let's continue on. I don't know, Tim, maybe you want to start here and then we'll transfer it over to Bill if you like.
Yeah, thanks, Marty. Appreciate the introduction. Tim Doran, as Marty said, I'm a director in our energy credits practice. In a prior life, I worked at a large Midwest electric utility where even before the Inflation Reduction Act, I was working on a lot of these tax credits related to renewable energy, specifically solar, wind, and hydroelectric power, renewable natural gas. So it was awesome to see the Inflation Reduction Act come through. It really energized and changed the way we think about these tax credits. It opened up the world to a lot more people than who were previously taking advantage of these. And in fact, I just read a report the other day that the early adoption, that is, the investment in these types of technologies and the use of these credits is already exceeding what the expectation was. And this thing's only been out for about 1.5 years. So this is really cool stuff. Now that I'm in a client servicing role, it's awesome to be able to help people take advantage of these. And to the extent that you're not, hopefully you hear something today that will key you into what we're talking about and provide you some insight into how you can go about getting some of the money that's out there from that Congress put out to invest in sustainable technologies. So I know I've said this previously, but there's it was interesting to see when the Inflation Reduction Act came out 1.5 years ago. We thought it was dead. A lot of folks, even within the Beltway, thought that it wasn't going to happen, and then we got surprised with it. And it when I say it changed how we think about these and open up the world to more people, we're going to talk through a lot of the ways that it did that today, and a lot of the stuff that is happening is coming online right now, and we'll talk through that. But it expanded the tax credits. It inflated them in the terms of how much money you get back when you're eligible for these, and then it made them available for more people. And then it also broadened the technologies that are applicable. So we had solar and wind in the past, but we've got a juiced up carbon sequestration regime, clean hydrogen, biogas, municipal solid waste. We have a lot of new technologies that are available under the Inflation Reduction Act. And I'm going to pass it on to Bill because there's another area that's super interesting that also got kind of, I say, juiced up, or the amount of benefit was increased substantially under the Inflation Reduction Act. And so Bill's our expert on that. But Bill, why don't you take it away and talk through that area a little bit?
Yeah, appreciate it, Tim. And first off, thank you everybody that's joining our conversation today. In the middle of your lunch break, I'm sure. So we really appreciate spending some time with us. Hopefully, we can walk away with some new information. A little bit about myself. I've been in this realm for a little less than 10 years now, and very similar to Tim, I had a very different background leading up to this. I actually spent 10 years before that in the construction industry itself. Started out installing HVAC systems, went through college, got a mechanical engineering degree, and got into construction management, and spent some time in that before getting into the tax realm. But getting on to our subjects for the day, the Inflation Reduction Act, there's a bit of debate as to whether it's actually going to reduce inflation in the long run. But what is absolutely not debatable is the massive investments that are being made, not only in sustainability, but also just in construction overall. In the United States, if you build, buy, upgrade, add to, renovate anything, a building in the US, that there's some sort of incentive tied to it. Now, of course, the topic du jour is energy efficiency, which is why we're talking about 179D and some other related incentives today. So a little bit of a recap for those who aren't familiar with it. The Inflation Reduction Act, as Tim mentioned, greatly expanded the energy efficient commercial building deduction, which is 179D. The salient points for it, maybe the most exciting points for it, are the new deduction amounts caps out at $5 per square foot, up from $1.88 per square foot, and that is adjusted for inflation. So in 2024, a eligible space can get up to $5.65 per square foot. And again, that will increase each year. As another part of the Inflation Reduction Act, the actual threshold to qualify has reduced. And the used to be to qualify, you had to calculate a 50% energy cost savings. But now that's reduced down to 25% energy cost savings is that minimum threshold. 50% is still the target, and we certainly like to see 50% energy cost savings, but 25% is the new minimum. The kinds of buildings that can take advantage of this have expanded greatly. So going all the way back 20 years ago to when this was first implemented in 2005, used to be that it was for commercial buildings, in that it was a for-profit business, a taxpayer owned this building, whether it's a strip mall, warehouse, office space, something like that. This deduction went to those kind of parties. In 2008, it expanded so that a government entity, whether it's a military base or a post office and everything in between, could then allocate that deduction. The government doesn't pay taxes, so it allows for a taxpayer to get that deduction. And that's somebody that's worked directly on that building, architect, engineer, contractor, design builder, something like that. Last year, the new rules came out, which to now include tax-exempt organizations that can now allocate these deductions. Again, tax-exempt organizations don't pay federal tax, so these deductions have to go somewhere, or now they can go somewhere. Again, to an architect or an engineer, contractor, et cetera, that's done relevant work. So what that means for us is now there's more money available than ever. More people can take advantage of it. There's more kind of buildings that can take advantage of it, because now these tax exempt entities not only include the government, but now churches, private schools, things like that. Additionally, a triennial reset of the deduction is now in place. So up until last year, you could take a deduction once for the lifetime of the building, which is great, but it's been 20 years since the 179D incentive was put into place. 20-year retrofit isn't energy efficient by today's standards anymore. So Congress recognized that and allows now for a new $5 per square foot deduction to be taken every 3 years, which is a really powerful tool. It's going to help taxpayers to plan out their projects in the future, right? If we can kind of spread our projects out so that we can pay for them easier, but also get that new $5 per square foot every single month. Excuse me, every 3 years. And then finally, and we're gonna go into some great detail about this. New rules associated with getting that $5 per square foot. A project that's going to pursue a 179D deduction must pay prevailing wages for the region that the project is in, and they must make a good faith effort to participate in a registered apprenticeship program. And again, we'll talk about that in greater detail. If you don't meet those requirements, the maximum deduction is $1 per square foot. Still pretty powerful, especially when we're talking about some larger projects here. And so yeah, that kind of brings us up to speed. It started as the beginning of 2023. Our experiences have so far have been amazing. First off, we're looking at buildings that are being placed into service in 2023 and forward as far as part of this new regime. Well, what does that mean as far as qualifying? Right now, the current standard that we are comparing buildings against is ASHRAE 90.1 of 2007. So a very old standard indeed, 17 years-ish. So what that means is that these projects that are coming online this year, whether it's new construction, retrofit, upgrade, expansion, as I mentioned before, they are always qualifying. We've done quite a few of these projects in the past year, and they are always yielding some sort of benefit. So if you're out there and you're saying, oh, we did some work to the building, we upgraded, some of the lights in some of the areas, but we wouldn't call it an energy upgrade. Rest assured that any kind of work that you're doing is going to be better than your ASHRAE standard of 2007, 90.1 of 2007. So don't think that because it wasn't particularly energy efficient or because we didn't target energy efficiency that it won't still qualify. It has been our experience that it will. The other thing, excuse me, the other kind of lessons learned that we've received in the past year is just who kind of the interested parties are. The for-profit taxpayer has enjoyed these benefits for a long time now. Of course, they're bigger than ever, so they're getting more advantage than ever. However, this expansion to include tax-exempt entities has really been a game changer. Chair Beckert, we've got a very large government and nonprofit sector. We represent a lot of clients there, and we've gotten a lot of interest from these institutions saying, look, we're putting these projects in service. What does 179D mean for us? And it's a great question. We're going to talk about in a little bit, Tim and David are going to cover some ways that nonprofit or tax-exempt organizations are able to directly benefit from some of these incentives. 179D is not one of them. There is no formal mechanism for an institution to directly benefit from 179D. However, there is nothing keeping an institution from monetizing it in some way. So a nonprofit organization or a government organization, they can get some sort of benefit via an arrangement with the taxpayer that's ultimately going to be getting these deductions. So what we've seen in the past year have been some great some great agreements between these two organizations that allow for, whether in exchange for an allocation, reduction in fees, extension of warranty periods. In the case of like nonprofits, an outright donation back to the institution in exchange for some of these allocations. And we're happy to have those conversations with you from either side of the table.
And so that's really part of what we do as part of our projects. We'll help get those allocation letters for our clients to the extent that they're the engineering design company, et cetera, and work with the owners of those projects to get them. And I think that's where a lot of value you add specifically.
That's right, Marty. Thanks for mentioning that. So, and we're going to talk a little bit about what to look for in a provider later today. But one of the things that we absolutely pride ourselves on is maintaining, helping, bolstering those relationships between you, the taxpayer, and your client, the tax-exempt entity, and vice versa, right? We represent tax-exempt entities for their vendors. 179D is a complex process. It's difficult to do. There's a lot of steps. It is some complicated language, and we wouldn't want to put you in a position where you're answering questions about the tax code in exchange for some of these allocations. So yeah, we like to be involved early in the projects. Let us know what you think may qualify, or we'll tell you what we think qualifies as far as looking at your portfolio work, and then begin the difficult but necessary steps of reaching out to these government owners and these tax exempt owners to get these allocations. All right. So moving on to the other side of the incentives world, the tax incentives world, 45L. So 179D is, of course, for energy efficient commercial buildings. 45L covers everything else, which is residences. So some major changes to 45L. Of all of the incentives that I'm aware of, and certainly of all the incentives that we're going to be going over today, 45L has experienced the biggest changes. However, they are also experiencing some phenomenal expansions. So, first off, 45L is specific for property developers and builders. If you are putting basis into a project during construction, then you could be eligible to receive some 45L credit. Up until 2023, so 2022 and prior, there was a benefit available of $2,000 per unit. That has changed now to a tiered approach for these credits of either $2,500 per unit or up to $5,000 per unit. So some really significant savings that we're seeing very quickly, even on some relatively small multifamily developments. So it covers pre-manufactured homes, single-family homes, but also multifamily units, where we're seeing the most benefit come from. As you can imagine, 100 units in one space, that adds up very, very quickly at $25,000 or $5,000 per unit. However, as I mentioned, the changes to how they're calculated, what you have to do, have been profound. And it's something that some lessons that we've learned over the past year, especially around 45L. So to qualify for either the $2,500 or the $5,000 per unit, your building, your project must reach and get certified for your local and national Energy Star program. So I'm sure you've all familiar with Energy Star. Energy Star appliances, computer monitors can be Energy Star, Windows. Well, you can now get whole buildings and whole residences Energy Star certified. And if you get that certification, you qualify for that $2,500 per unit. And what we're seeing now in the past year is that this is really important that you voice your interest in getting this certification early on the project. Energy Star is a multi-step process. It's a very big checklist, and that checklist starts with a design review. So if you are in the middle of construction now, reach out immediately. It's very important that we go back and look at your project, the design, that a Energy Star rater signs off on the design to make sure that it's going to meet the requirements. So that's step one. The other thing that you have to do is register with Energy Star. You have to register your project with Energy Star. It's not something that you can do on the back end. If you are in the middle of a project now, if you are in the conceptual stages of a project now, if you're trying to get funding and this is something that you want to pursue or that you're interested in pursuing, reach out to us right now. We have there's a lot of questions to get answered before you get too far in the construction process. In addition to a design review, an Energy Star rater also must review the actual construction. They do what's called regular field visits. They'll go in and observe not only the equipment going in, but the process of construction. One of the kind of stop points in a project is the witnessing of the installation of insulation. And sorry that the words kind of sound so similar, but if you've hung drywall and you haven't done one of these inspections yet, you could be too late. Of course, you can pull the drywall back off and have your Energy Star rater view it, but it is a very important part of the process and something that you cannot get a certification without. So again, big takeaway over the past year, our experience is, reach out right away. Start asking these questions. Don't wait until you're halfway through construction to say, oh, maybe we should be pursuing these credits. In addition to the Energy Star program, the Zero Energy Ready Home is a kind of add-on to the Energy Star. So if you meet the ZERH program requirements, then you can get an additional $2,500 per unit. It's going to regularly update. It's changing this year and it'll change again this year. So your project must have things like solar ready. Doesn't have to have solar panels on it necessarily, but it does have to have the electrical infrastructure installed. It has to be strong enough to hold up solar panels. It has to have enough sunlight. So it's going to be in a geography that's compatible with solar. Also, there's overall energy consumption requirements. There are air quality standards. They're starting this year and expanding next year. EV charging station requirements. If you want to get this extra credit, you have to start installing EV charging stations for every single parking space for a single family home, and between 20 and 40% of every single parking space for a multifamily unit. So again, to get these benefits, it's really important that you start asking these questions now for your future projects. And if you take anything away from that from this slide, call us now. With that said, both of these regimens require, again, that prevailing wages be paid on the project. 45L is unique to the Inflation Reduction Act in that it requires prevailing wages to be paid, but not apprenticeship hours. I feel like that may have been a bit of an oversight when they were writing it. I don't know why they would leave that off, but it has been our experience. We're understanding now that prevailing wages are a requirement, but not the apprenticeship hours. And again, we'll talk to those in a little bit more detail. Moving on. Oh yeah. Okay. So getting into those requirements, you're going to experience these requirements associated not only with 179D, 45L, but also the ITC that we're going to be discussing here in a little bit, and a ton of other incentives. For those of you that are working off federal grants, doing construction using federal money, those have been requirements for some time. For those of people that have been in the construction industry a long time, you call it Davis-Bacon wages, but now we just call them prevailing wages. So the prevailing wage requirements were thankfully explained to us in a little bit more detail using Special Notice 2022-61. It provides us with guidance not only how to meet those requirements, but how to properly document it, which is a very important part of the process. And that's also something that we at Sherry Beckert will help you do. If you've got a lot of projects with a lot of personnel, a lot of work happening, and you've got a lot of wages coming in and out, you've got subcontractors, let us work with you to develop a process for documenting that you've met these requirements. Because again, it's not only important that you meet the requirements, but that you document it correctly. The penalties for representing that you did meet these requirements, but not meeting them are pretty severe. So we want to make sure that you've got everything that you need in case anybody asks any kind of questions. Martin, yeah, next slide.
Okay.
So the apprenticeship hours are very similar to the prevailing wage requirements in that these have been requirements for federal projects for some time. However, we're going to see them more and more in these incentives as time goes on. An apprenticeship requirement is met if you make a good faith effort to participate in a registered apprenticeship program. We can provide you guidance on what it means to be registered or a qualified apprenticeship program. There's lots of resources that are available, apprenticeship.gov, for instance. But the punchline is that your project, to meet these enhanced deduction or credit limits, must work a certain percentage of your hours through apprentices. Starting in 2024, that's 15% of all hours worked. If you are unable to get that many apprentices, they just don't show up, or you can't get people interested in your particular project. As long as you've made that good faith effort, you can be exempted from that requirement. And again, we'll take you through what it means to make a good faith effort and ultimately document those efforts. Marty?
Yep. Here we go. All right.
Yeah. And just here's some kind of regulations for you, some kind of locations that you can get this information. We're learning more about this as time goes on, and we're going to as these first kind of rounds of filings go, we're going to understand more about the actual documentation requirements, what the service is going to be looking for. But again, it's important that you give this your due thought if you're going to pursue these kind of credits and deductions.
All right. And I promise everyone that there are 4 polling questions. We're going to get to it soon. The first one, and then they're interspaced a little bit more toward the end. So we'll get to all of them right now. But Tim, let's get moving here. Thank you.
Marty, I'm actually taking this section. Hi,
Ah,
I'm
very
Dave.
good, David. Continue. I'm
I'm
sorry.
Dave Momani. Quick background. I've spent 7 years at a Big Four working with the investment tax credit and the production tax credit, and then eventually the IRA as that came about. So the first credit we're going to talk about is the investment tax credit, and this provides a tax credit for investment in renewable energy projects of qualified energy property. These are types of things are solar, wind, combined heat and power, battery storage. There's a pretty exhaustive list of what qualifies as qualified energy property. The base credit rate is 6%, but that's increased to 30% if you meet prevailing wage and apprenticeship requirements that Bill was talking about. So, for example, if you install a $1 million solar farm, if you hit the prevailing wage and apprenticeship requirements, your tax credit will be worth $300,000, and that can even be expanded more based on some enhancements, which we'll go over in a bit. So a couple more notes on ITC, excuse me. That is a tax credit that you apply against your tax liability. There is a 5-year recapture period for when the property is placed into service. One of the cool things about the IRA is that prior to the IRA, we had a 1-year carryback for this credit. So now we have a 3-year carryback. We also had a 20-year carry forward previously. Now it's 22. So we've seen clients, interested in not only eliminating their tax liability for the current year, but then to look back at the prior years, which is something we didn't have the ability to do to such an extent prior to the IRA. And below that, we have some of the technologies I mentioned: wind storage, biomass, geothermal.
And David, that 3-year carryback is certainly making people interested in purchasing credits such that they can eliminate tax liability. It's certainly juiced up that market that we're going to get to, that I think Tim will talk about a little bit more, but that's a very important thing that was added in there.
100%. Okay, then we have the other of the two tax credits, which is the production tax credit. So this is a little more of a complicated calculation. This is based on the production of electricity or qualified renewable energy that an asset produces. The base credit rate is 0.3 cents per kilowatt hour. Similar to the ITC, if you hit prevailing wage and apprenticeship, that's going to be increased 5 times. And it also has these enhancements that we're going to discuss a little bit later on to get you above that 30%, or in this case, 5 times the 0.3 cents. And so the way the ITC works is a credit you receive in year 1 in which the asset is placed in service. For Section 45 PTC, this is a 10-year credit period. So once the asset is placed in service and starts generating this electricity, that's going to be a 10-year recurring credit that you're going to get based on the production. And the rate that's used to calculate it is also adjusted annually for inflation. And then one important note, which is we got some questions around, can you do both for the same asset? And the answer is no. So it's either or. So you have to either choose what's going to be more beneficial, the ITC and PTC. And one thing that we do for our clients that are considering an investment in this area is we will actually model out the benefits of both ITC and PTC and see where we come out in the long term as far as which credit makes more sense for them and their firm. Okay, and these are the credit rate increases that I was mentioning a little bit. So we have the 5 times, which is for prevailing wage and apprenticeship requirements. And then there's an additional 10% that you can get if your facility meets domestic content requirements. And what we mean by that is if the materials being used in your project are sourced domestically in the United States. And there's an additional 10% credit if the project you're placing into service is in an energy community. And that's a map that's been provided by the DOE where you can go just type in your address and see, is this a qualified energy community? Again, there's an additional 10% if you have an output less than 5 megawatts. And then there's a kind of difficult one to get that's a 20% if you're in a qualified low-income residential building. Those we haven't seen a ton of because it's a very specific criteria to qualify for that. Okay, and then before I hand it over to Tim, since the IRA, there have been a lot of trends that we've noticed. Again, this is still somewhat in its infancy, so these things might change, but these are the topics that we've gotten the most questions about thus far. One of those being 48C, which I believe is what we get into next. And then we also have how tax-exempt organizations are able to monetize these credits because they previously were not able to. Another huge part of what we talk about a lot is the transfer of credits, so the purchase and sale of tax credits. And then a couple more, in the last 6 months, we've gotten a lot more activity around is Section 45V clean hydrogen and Section 45X advanced manufacturing credit.
All right, let's get to 48C, something we're really psyched about this year. Tim, take it away.
Yeah, absolutely. Thank you, Marty. We are super psyched about that. And I am going to take one quick pause before we jump into this, though, because I wanted to layer on to some of those topics that David was talking about in terms of updates that we've seen going into this year. At the end of last year, we got several dumps of regulations from the IRS. They're proposed regulations, which means that taxpayers can generally rely on them in the interim, but they are potentially subject to change. We've had comment periods on them. There are some interesting updates. If you go to our website, you can see some of those. We don't have time to go into detail on them today in this particular hour, but there are some impactful pieces of information that the Treasury made determinations on. I think broadly speaking, there wasn't anything earth-shattering. A lot of it had to do with what we are knee-deep in the muck helping clients understand and work through, and that is what is the actual cost basis and equipment that's eligible for these things, and when does a solar facility start and end, for example. So we got a lot of information on that, and we're continuing to stay abreast of those types of topics and work with our clients to understand what it means for them. But 48C, as Marty mentioned, this is an exciting place, and David mentioned it too. We're getting a ton of questions about this. There's an urgency to this section, and want to make sure that people understand that. So this is not the first time we've seen 48C. I think it was maybe a little over a decade ago. Congress had done something similar. This is kind of a revamped, just like everything else we've talked about in the Inflation Reduction Act, increased idea around 48C. But Congress outlaid $10 billion to specifically go towards what is mostly manufacturing type organizations. And the concept behind this is going green, and that falls into a couple of different buckets that you see here. But before we get into those, so we'll talk a little bit more about this. But the reason I say there's urgency is because there are windows that have opened up and are about to open up where you can put in an application for the Department of Energy to go after these credits. Once those $10 billion are used up, the $10 billion are used up unless Congress makes a decision to put up more out there. So this is a limited time, limited amount of funding opportunity for folks that qualify to get their concept paper put in and try to get some of this money that's out there. In the first go round, Congress outlaid, or the IRS opened up a window for $4 billion of the $10 billion. We have heard, and I can't testify to this accuracy, but we have heard that somewhere north of $40 billion in potential applications came in the door against that $4 billion. We think it's going to be much less this next opening window, which means the opportunity to gain a piece of that pie is potentially going to be greater. The 48 capital C credit applies to these three kind of broad types of energy projects or buckets. One are projects that re-equip, expand, or establish an industrial manufacturing facility which produces or recycles certain products, and we're going to have a slide that walks through some of those different categories of manufacturing that could apply. The second one is a little bit broader in that energy projects for manufacturers that specifically re-equip an existing industrial manufacturing facility with new equipment that reduces greenhouse gas emissions by over 20%, or fall into similar buckets, are eligible for going after this credit. And then the third one is energy projects that equip, expand, or establish an facility for recycling critical minerals, and we'll talk about that a little bit too. Those are the kind of buckets here that we're talking about. What is 48C? Well, you are allocated, and I'll talk to these projects in a second, but just so you have an understanding of what we mean here, you're getting a 30% tax credit, like the investment tax credit, similar in that you would monetize it against your federal tax liability, but you're allocated that credit out of these funds. And you will, if you are approved and allocated the money, you'll receive an allocation letter from the IRS saying what amount of money you're allocated for what project. That first bucket, here are the types of projects that qualify. So property design produces energy from the sun, water, wind. What does that sound like? Well, it sounds kind of like the investment tax credit. So to the extent that you're manufacturing these types of components or widgets that meet these qualifications, then you potentially can put your hat in the ring for this 48C credit. Fuel cells, electric grid modernization, carbon sequestering equipment. You can see the list on here. There's a variety of different types of things. I think it's important to point out too, though, that, you know, if you meet the qualifications of some of these first buckets of qualifying type production, awesome. But there is a catch-all provision which says other advanced energy property that reduces greenhouse gas emissions. So don't count yourself out if you have something really cool going on, or you're doing some kind of innovative manufacturing. There's an opportunity, and that's kind of the thought behind this Section 48C2. There's a reason you have to put together a concept paper and put it in front of the Department of Energy. Congress wanted a lot of different types of things to be potentially eligible for this credit. They didn't want to be as limiting, and they created a regime where they could go about identifying and getting credits into the hands of the people that they wanted to have it, and this is the mechanism for doing that. Category 2 projects, right? So this is that second bucket. This is where we're re-equipping an existing manufacturing facility where we have this threshold of direct or indirect carbon reduction, where and we have a couple examples of, once again, examples of things that are like provisions where we can say, hey, I'm meeting that, but there's also another catch-all at the end here too. So if you're installing lower zero carbon process heat systems, if you're capturing carbon from your industrial facility now and you're installing new equipment to do that, if you're doing a better job at storing energy or utilizing waste energy, if you're creating efficiency out of how you handle your waste, or you're reducing your waste from your process, all of those types of things that flow into this category type 2 for the 48C credit are things that you want to be thinking about and potentially going after, putting together a concept paper to try to take advantage of that. So as we talk about that, I think it's a great segue too into what I mean by the timing this year. So last year, the window opened up in the summer for 2 months where you could put this concept paper in front of the Department of Energy. We don't have the specific dates yet, but several IRS officials, Treasury officials at a conference had indicated that the second window will be opening up. Everybody that I have talked to is of the opinion that it's going to be around the same time frame. So June and July.
Last year it was June and July. Exactly.
Yep.
You got 2 months. Exactly.
Yeah. So you have 2 months to get this concept paper in. You put the concept paper, there's a portal, and I think they're actually, I just read they're moving the portal around, but there's an online portal that exists, and you put your concept paper in front of the Department of Energy, and they're going to review everything that you've got going on. There's a notice with an appendix that has a list of all the information that they want to see. So you put that in front of them. The DOE is going to give you a thumbs up or a thumbs down. Once you get that thumbs up or thumbs down, and that came for the folks we've been talking to, that came at the end of the year. So sometime November, December timeframe, you get a thumbs up or a thumbs down from the Department of Energy. You then have a limited time to take and put together an application in front of the IRS, where you also give them what the DOE said to you. And the IRS then takes that, ultimately approves your application for the credit, and you'll receive an allocation letter. The IRS has indicated that they're going to be done giving out those allocation letters by the end of March this year. So less than a year's time has occurred by the time you put your concept paper and you get your allocation letter from the IRS, knowing that you can take advantage of this credit. The important thing to note is you can spend money, you can be working on developing whatever this project is that you have going on, but you cannot place the credit producing assets into service until after you have that allocation letter. So there is some timing here to be thoughtful about, and that's one of the things that we're helping a lot of folks understand is how do I time for this? How do I make sure I'm taking advantage of this? But I think a key takeaway is once that window closes this summer, that's it, right? This particular credit, some of the other credits are going to be available. They have a long runway, of almost a decade or more. But this one is not like that. So you can go past the side. We've kind of already talked about that a little bit.
Yeah. And I want to get to our first polling question, and there are 3 more coming quickly. So anyway, are you or your company considering upgrading or expanding facilities that increase efficiencies? Yes, no, or not sure. And Tim, if you want to take any time during this minute while people are going to continue any of the thoughts you want to have, go for it.
Yeah, no, thanks, Marty. I think it's a great time to kind of wrap that up. So there's an awesome credit out there. What we have talked to a lot of folks is if you're already having planned investments into types of stuff that would qualify for this, it's hard to make a justification of not putting together this concept paper of, you know, however many 10 to 20 pages that outlines all the detail they want, and see if the Department of Energy doesn't give you a thumbs up and say you're good to go, because 30% back on your investment into these qualifying assets is that can be a pretty big chunk of change. And we'll talk next or soon about how you might monetize that, even if you don't have necessarily the federal tax liability to slap that credit against.
Just waiting for the results to come through. And there we go. Okay, so yes is 26%, no is 45%, not sure is 30%. So somewhere between that 30 and 26 might be interested in speaking. All right.
Cool.
All right. And we did this already a little bit.
We talked through this application process. I got ahead of the slides, but
that's helpful for those that are waiting for additional polling questions as we come through. So
yeah, and as we said, I think these slides are going to be available so folks can use this as a reference guide to kind of see what we've kind of talked through. Yeah, updates. I talked through this. Tax exempt organizations. Okay, awesome. So Bill mentioned this in the 179D concept. We have this in the credit concept, and we are working with a lot of folks. This is across the board tax exempt organizations, from governments to nonprofits and charities. To the extent that you are investing in some of these different types of technologies that we've talked about, you can now go after these credits, even if you've never even thought about federal taxes before, because you don't pay taxes because you're a tax exempt organization. There is a form that gets filed. There is actually a form and an attachment form that gets filed. There is a registration system that the IRS has created so that you can go after these direct pay, but they will cut you a check back on whatever your calculated credit is and send that to you if you're investing in these. We have talked to folks. This is so important because I think we've talked to folks who have got the budgets and have started investing in these technologies, having no information about the fact that they could get this money back, reduce their costs, and maybe take that capital and put it to use in other beneficial ways, because they can get a check back. There's going to be a little bit of a timing lag, right? Because you're going to place the property into service, and then just like a normal federal taxpayer, you're going to file the form after that tax year, and then you're going to wait for the IRS to cut you that check back. But we're talking about those investment tax credits potentially where we're seeing 30, 40, 50% back on an investment, which is enormous. Yeah, so how does it work? So a tax-exempt organization makes an investment in some of these clean energy technologies, whether it's solar or battery storage, or, you know, some of the things that Bill and I were just chatting the other day, electrochromic glass in certain circumstances where you have glass that can turn on and off and allow light in and out throughout the day to reduce heating and cooling costs, that kind of stuff. There's a lot of different technologies that applies to, but to the extent that you're investing into some of these qualifying technologies and you're an entity that's eligible for direct pay, you're going to go in, notify the IRS of your intent to claim the direct pay. You're going to place those assets into service, and then you're going to file, generally for most tax exempt organizations, it's a form called the 990-T. And then you're going to attach the normal credit form that a federal taxpayer would pay that identifies how much money you're claiming in credit. And then eventually the IRS is going to cut you a check for that amount of the credit. So this is new, right? This is for stuff that was placed into service in 2023. A quick note there, because we've run into this with a few people. You know, you have to do a little bit of thought around what your tax year is, because, well, a lot of federal taxpayers that we typically have worked with are calendar year taxpayers. A lot of tax exempt organizations have a different fiscal year. So this is for stuff placed into service in the tax year 2023 and beyond. The IRS opened the portal at the end of last year so that people can begin to register their projects. And another important note, this is from the IRS. They advise engaging in the pre-filing registration process at least 120 days before you intend to file that return where you're claiming your direct pay.
All right, polling question 2. Are you aware of any tax-exempt entities that may be considering installing technology that's eligible for direct pay? Yes,
Yeah,
no, go for it.
Yeah, I mean, just, when we're talking through this, I think one of the things that we're seeing, the heavy hitter, the low-hanging fruits is solar. Solar is such a big deal right now, and we're seeing solar across the board, from investment funds to, community banks to tax exempt schools and universities. Everybody is looking to put solar in, and we're working on people coming online to build new solar producing facilities in the US too, because solar modules are in high demand. But to the extent that you have projects like that or some of these other technologies going on, I think it's important that people know that this is out there.
We'll leave this open for a little bit, a few more seconds as answers trill in. And then continue. All right. Yes, 11%. No, 78%, and maybe 11%. So it's
There's some
not
out there.
yeah, there we go. All right. All right. Purchase and sale tax credits. Clearly something very interesting to
Yeah,
not only those placing them into service, but those who have a tax liability who want to reduce it.
yeah. So this is where this Inflation Reduction Act really blew the doors open, because now the advantages of tax credits in clean energy are open to people who don't even necessarily want to directly invest in clean energy, right? So this is important. I think there's two categories of people that it really matters to. One are those who are investing in these clean energy technologies, but don't have a federal tax liability. And maybe they're not expecting to have one for a while. And so they're saying, well, how do I monetize this? Well, you can go out to a market now, starting this year, and sell your credits to somebody else who does have a federal tax liability and take advantage of them. Obviously, the idea that Congress was trying to come up with was, what about those folks who fall into that category? How can we continue to provide an incentive for the people that want to invest in these types of technologies who can't otherwise monetize these? We have to have a better mechanism. There was an old mechanism. There were a couple of different ways in which you could potentially monetize these credits: through partnership tax equity structures, through sale and leaseback structures. The problem is that the types of people, because there's a large transactional cost to that, so the types of people that were typically entering into those arrangements were large institutional lenders and financial institutions, and then large institutional utility type companies. But the idea behind the Inflation Reduction Act was, how do we get smaller scale, middle market, even individuals invested in these types of technologies? And this lowers the transactional costs significantly. Now you can go to a market and sell it, and you don't have to engage in these sophisticated structures and pay people to design them for you. Now you can just you can sell directly. There are some interesting notes about this, though. It is a consideration that the transferee pays for the credit, and then it must be in cash. So these are cash only transactions. They are for a specified portion of the basis. So you can under the proposed regulations that have come out, sell a portion of the credit on a single eligible credit property to people. As a condition, there is a registration process, just like direct pay. And the idea here is the IRS wants to track these projects to the extent you're doing that to avoid abuse and fraud. So you're going to go in and register before you do this. And then the eligible taxpayer, both the seller and the buyer, are going to make those elections on their return. What's interesting is there's no income tax consequences for this transfer. So it's not considered property. You don't recognize gain and expense. You simply move this credit fiction from one party to another one time. It can't. There's not going to be like a futures market here. This is a one-time transaction that takes place, and the person buying the credit gets to claim it. What does that look like practically speaking? Well, suppose I have $1 million in federal tax liability, and somebody else who doesn't have any federal tax liability just put in a solar project that cost them $3 million, and they generated $1 million federal tax credit that they can't claim on their return. They can sell that $1 million credit to me, and I will buy it for, suppose, $800,000. I get to wipe out what would otherwise be a check to the federal government of $1 million for the cost of 800 grand, and I recognize that difference minus whatever other transaction costs exist. Yeah, I think the point there too is, once made, the election is irrevocable. This is kind of walks through a little bit of an example of what this might look like. I kind of spoke to this already in high level numbers, but this is there if you want to take a look at how that might work. There are some limitations here that are important to recognize. So in this world of credits, there are Section 469 passive income rules that can apply in certain instances, especially to individuals. So this is a pitfall to look out for. If you are subject to passive loss limitations, and you are purchasing these credits through this transfer regime, you might not be able to apply them against your income if you don't have passive income. So definitely something to be wary of. Generally speaking, large shareholders, C corps aren't going to have to worry about it. But this is definitely out there. The other thing that's really interesting on this slide is the fact that we have marketplaces that have come online. Our firm, David and I and Marty, have been actively working with some of these new marketplaces. I think we have a little bit more time to learn who are going to be the most reputable and the best places to go. But there are places that you can seek these credits. What's an important thing to recognize about that? Well, you still need to be doing your due diligence. If the IRS goes to the person who sold you your credit and audits them and finds that it was a bad credit, or they trip themselves up with the recapture provisions, your purchase of that credit is subject to recapture as well. So it's important that you're working with a reputable advisor to make sure the credit you're buying is good. I think with the right amount of information, that risk that it's bad is low, but you need to make sure you're doing the due diligence.
All right, polling question 3. Could you or your company benefit from either selling or purchasing tax credits? Certainly, purchasing is going to be something that could be valuable to many companies that have a federal tax liability. So for those, it could be yes. The question is whether you are interested in going through it in this new marketplace. But we'll leave this polling question open, and we'll just sit and wait for that to come in, unless Tim or David, you have anything else to add right now? And just for everybody on here, we're definitely going to make our time. This is well timed out to end at 2 o'clock. We'll get to our 4th polling question right at the end. And again, I just want to thank everybody who took the time, as Bill said, during your lunch hour to tune in to us today. It's certainly appreciated. As mentioned, 800 plus invitees today, and a lot of good information out there and a lot of new developments. So thank you to everybody out there. All right. So yes is 24%, no is 42%, and not sure is 34%. All right, very good. All right, we'll talk. This is one of our last topics here. Clean hydrogen.
David, we got about
credit.
6 minutes, so you'll probably want to move quickly through this, but this is some new stuff that's come out as well.
Yeah, so just a couple quick points. We have a clean hydrogen production credit for producing clean hydrogen. The credit rate is 0.6 kilograms multiplied by the applicable percentage. There's a model out now that helps you determine the applicable percentage. And again, this is also subject to prevailing wage and apprenticeship requirements, so you can increase this credit amount 5 times. We've had a couple updates, which we'll share on the next slide in relation to this credit. So recently, the DOE released a white paper describing how you assess the lifetime greenhouse gas emissions with respect to hydrogen production. And then they also, as I mentioned a second ago, they released a model which you can now use to determine these life cycle emissions and how you would be reducing them. So those are kind of things we've seen. Again, these are things that are new for everyone. So we're getting questions about it, kind of working through the legislation as well as how it's actually being applied in the market, but it's something definitely to be aware of in the coming months. And then again, another part of the updates, there were proposed regulations on how the clean power must be used. So sourced from power facilities that began commercial operations no more than 36 months before the plant was placed in service has to be matched with clean power generation starting January 1, 2028. And the sourced from a power producer that's in the same region. So it does have some type of geographic ties to where the production is being produced from where it's sourced.
All right. And then lastly, but definitely not least, is 45X, which has some overlap with 48C. And you can claim only one or the other. But David, why don't you get into that?
Yeah, so quickly here, 45X is a tax credit, like Marty mentioned, it's either 48C or 45X, you can't claim both. And this provides a tax credit to people that are manufacturing components that will go into an eligible technology. So the credit amount varies a lot based on what you're actually producing, whether it's a PV wafer or an inverter that goes into a technology that's eligible for the credit. So essentially, what this credit does is if you are a manufacturer who makes, let's just say, inverters, you can actually get a tax credit for the production of that asset, that inverter that's placed into a larger system. And the tax credit is recognized when it is sold. So it's not you make it and you get the tax credit. It has to actually be sold.
I think this is interesting because what we have here is a number of eligible technologies, components, et cetera. And so to the extent you are expanding or re-equipping a facility right now for the production of these things, 48C is something to look at in the immediate term. But if you're already doing it or you miss the 48C application window, you still have another bite at the apple here in terms of 45X and a overtime production tax credit. So all is not lost if 48C is not taken advantage of. Its intention is really to inspire re-equipping immediate capital implementation into these types of facilities. But if you have a facility up and running, you have something in the long term that you can still take advantage of.
Again, this is just kind of some of the eligible components and what the credit rate would be. We kind of have 2 slides of this, which we'll disseminate after this meeting ends. Again, some more of the eligible components. Okay, and we have some of the updates. So one of the big updates was we got a detailed definition of what eligible components produced by taxpayers require taxpayers substantially transform the elements or some components. So what we're saying is if it's functionally interdependent with this statement, is that component actually necessary by itself to once it's added to a larger component to be eligible for the tax credit. Okay, and I think this is one of our last slides here. Yep. Okay, let's get into this.
Why don't you cover it a little bit? We'll get back to it for a second, and then we'll do the polling question at the same time. Are you interested in learning more about what's eligible under 45E and 45X? I certainly hope the answer is yes. And I hope today that this presentation, while obviously we covered a lot and also not that much, but it took an hour just to get through what we had. Inflation Reduction Act is expansive. It goes beyond energy type activities as well. But for our purposes here, we talked about some of what we see most in interest among our clients. Again, real estate construction, to the extent you have a commercial building and you are making an enhancement to the HVAC or the building envelope or the lighting, think about 179D and what we can maybe do to help you. Beyond that, if you're manufacturing or placing into service any of these energy efficiency or qualified energy property types, think about how we can help you with respect to getting a credit immediately on your return, getting you a credit over time, or potentially purchasing credits that someone else generated by placing the property into service. We're going to wait for the polling results, but I'm also going to say thank you to everybody who joined, and we're going to finish up after this. All right, so there we go. Yes, are you interested? 18%, no, 57%, not sure, 25%. The not sures, clearly that's a matter of helping you guys understand education-wise, or just thinking about what your company's going to be doing going forward in the future. Again, everybody, thanks so much for joining. These slides will be available, and feel free to reach out to any of us on this call just to help you out. Thanks. And then last point, credits and incentives providers. I don't know, Bill, if you still want to talk about this. We have about almost no minutes, but to give it 30 seconds.
So for anybody who wants to stick around for a little bit, just want to reiterate that these incentives are not new, but they are greatly expanded just in the past year. And we're seeing a lot of people come out and begin to offer these services. And while it is, of course, our hope to work with every one of you to provide these, there's some thoughts to kind of take with you when you're looking for someone to partner up with you on this. What is their experience level? How long have they been in this space? Are they an engineering firm that all of a sudden they decided to kind of add these services onto their portfolio? Have they been through an audit before? What was the results of those audits? Are they working with third parties? Are they offshoring any of their work? There's certainly nothing wrong with partnering with a third party, but I mean, what is their experience level? What is their cybersecurity like? If you're working with a government or a private institution that has strict cybersecurity rules, what kind of information is being sent to these third parties? Or is it all done in-house? In some cases, there's an inspection of the facility that's required. Who's performing it? Are they do they have the correct licensure? And of course, at the very end, when we're working with tax-exempt organizations, what's their experience level with working with that kind of institution? We're speaking to our clients' clients, and it's very important that you're maintaining that those relationships, right? That you are not badgering these people for these incentives, because we understand that these companies are not in the business of tax incentives. So allow for an expert, hopefully like us, to step in and answer those questions for you. Marty, thanks for the opportunity, and thank you to all for joining us today.
Thanks everybody for joining today. Appreciate it.